Hello everyone. So today in this session we are going to start with the most important model in this particular chapter dividends called as Modigliani and Miller approach, also called as a model, Modigliani Miller model. This particular model we will make our discussion in 6 parts. Okay, 6 different parts we will be continuing our discussion. First one will be the basic introduction, and the second part will be about an example, and the third one will be with regard to the summary of entire discussion, later understanding the balance sheet interpretation. Okay, so I have the notes with me. Number 4 I have written is theory of irrelevance and formula. After the derivation and interpretation of the formula, sixth one will be illustrations from the study material. So in 6 different sets, we are going to complete this particular area called as Modigliani and Miller approach. Very commonly asked question in examination. 3 models are there: Walter, Garden, From these 3, one question will come in exam. Pakka. So you can expect a 6 to 8 marks. Modigliani Miller approach question is most important in this chapter entirely. Okay. Two-stage dividend discount model from CA final itself I kept the problems there. So those we have to do. After completion of approach everything, dividends law institute related problems also let us do. Very simple. If you do CA final problems, this is just a cakewalk. Therefore I asked you, so listen to that lectures, do those problems directly. That will be more than enough for CA intermediate. Okay. So even before we go into the next part, so what is the name of the topic we are going to start today? Modigliani and Miller approach. What is the name? Modigliani and Miller approach. So what is the real meaning of this particular model? What is the concept relating to this? Everything let us try to understand. Okay. So let's see the screen. So see here. First, what is the idea behind this Modigliani and Miller model? And moreover, I said the 6 parts will be there. Let me show all the 6. This is introduction, part 1. Example, part 2. Balance sheet interpretation, part 3. Theory of irrelevance using a formula, part 4. Formula only written that can never happen in our classes. In our class, the thing that we do is we will also derive the formula. This is a derivation for the formula. Lastly, the illustration from institute study material. Okay. So in 6 parts, we are going to complete this area called as Modigliani Miller approach. Okay. So let us first try to understand what is the model and what is the intention of this particular model. Okay. So let us start. Firstly, so I will do one thing. I will take a rough draft. Problems and other things I will explain in that page. Concepts, everything we will see in another notes. See here. The model name is Modigliani and Miller model. Rough I will explain here. Fair you will write the notes. Okay. Whatever I have written in the notes, in a rough draft I will write here. Okay. In a rough draft I will write here. As a part of a notes, you can write in the next issue. Okay. So even before we go to the next part, first let me explain you the concept clearly. Modigliani Miller model. What is so great about this? Let us take Walter model. What is the idea behind the Walter model? What is the idea behind Walter's approach? P naught equal to D by KE, or you can write as D plus R by KE into E minus D whole divided by KE. Okay, into E divided by E minus D divided by KE. There, what is the next thing that we understood? If companies R is greater than KE, then go for 100% retention and 0% payout. 100% retention and 0% payout. If R is less than KE, 0% retention and 100% payout. I repeat, R is greater than KE, 0% retention, 100% retention and 0% KE. R is less than KE, 0% retention and 100% KE. Okay. Now listen, see the formula clearly. P naught equal to, if I pay dividend, I will get one share price. If I don't pay the dividend, I will get another share price. Sir, I didn't understand. Sir, I will give you one info. Let us say D is 2 rupees. Okay, D is 2 rupees. Let us say R is 0.15, K is 0.12, earnings is 10 rupee, dividend is 2 rupee. Whole divided by 0.12. Calculate. 2 next 0.15 divided by 0.12 into 8. So 12 divided by 0.12. So what is the price of the share? 100. Now answer. I will take another example. Dividend is 0. Dividend is 0. Okay. Now equal to 0 plus 0.15 by 0.12 into 10 minus 0 whole divided by 0.12. P naught equal to, take the calculations, 0.15 whole divided by 0.12 into 10 whole divided by 0.12. The price is rupees 104.17. Rupees 104.17. Okay. Now tell me, two observations we made. In this case, R is greater than K. As per Walter model, what you have to do? 0% payout to 100% retention to get optimum price. So 0% payout and 100% retention, you got 104.17. Okay, and here 100 rupees. From this, what you have to understand? If you pay dividend, you will get one price. If you don't pay dividend, you get another price. Means, as per Walter model, will the dividend payment or non-payment affect the price of the share or not? Necessarily it will affect. Okay, if there are 10 shares in the company totally, okay, what is the worth of this company now? 1000. Okay, 1000. If you don't pay the dividend, the worth of this company is not 1000, it is 1040.17. From this, what you have to understand? If you pay dividend, wealth will be something. If you do not pay the dividend, wealth will be another thing. Means, in the formula, D is there or not? Yes. What does it mean? Dividend will affect the wealth or share prices is what Walter model want to convey. Okay, this much discussion I made only for explaining you that Walter model and the Gordon model, both of them are focusing only on dividends impact on the share prices or dividends impact on the wealth of the company. Now we are going to see such a model where the dividend is not at all a significant factor which will affect the wealth of a particular company. That model is called as Modigliani and Miller model. Okay, in Modigliani and Miller model, what is the focus point? The focus point is not on whether to declare or not to declare. It will be on investment opportunity. Sir, I didn't understand what you said. Therefore, I will explain. See here. Okay, see here. Every company will have three decisions to make. One is dividend decision. Another one is, first one is dividend decision. Next one is financing decision. Third one is investment decision. Third one is investment decision. Dividend decision, financing decision, investment decision. Gordon model, if you take, P naught equal to D1 by KE minus G. D is there in the formula for calculating the P naught or not? Yes. That means for calculating the price of the share, D1 is one of the element or not? Yes. Means what does it mean? Dividend will affect the share prices. As per which model? Gordon model. Therefore, again dividend is relevant for pricing a share or not relevant? Very much relevant. If you declare dividend, one value will come. If you don't declare dividend, another value will come to the share. But the Modigliani-Miller approach concentrates on a issue saying that a dividend, whether you, I repeat, dividend, whether you have declared or not declared, financing, whether by way of equity or debt, irrespective of these four, you may declare dividend, you may not declare dividend. You may raise financing for the company by equity or by debt. Anything you may finance. These two decision making will not affect the wealth of the company. Walter model, if you pay dividend, one value will come. If you don't pay, another value will come. Yeah, okay. So financing decision means what? Whether you may finance either with equity or you may finance a company either with a debt. Modigliani-Miller approach says that whether you focus on equity financing, whether you focus on debt financing, whether you declare a dividend, you may not declare a dividend. Anything can happen, but the wealth will remain unchanged. It is the model's intention. Which model? Model. They proved that as well. How? Through investment decision. Modigliani-Miller approach said that if a company is having a good, remember this good investment opportunity. Sir, what do you mean good here? Interpretation is there for the term good. Later at the next stage of discussion, we will understand that whether a company may declare dividend, may not declare dividend. It may finance either with equity, may finance with a debt or a combination. Anything can happen. If the company is having a good investment opportunity elsewhere, the wealth will not be affected. So how we can prove this is the intention of this model. So summarize everything. All the previous model like Walter model and Gordon model focuses on emphasizing that the dividend decisions are definitely impacting the prices of the shares. This is the intention of the previous models. But this particular model says that whether you may declare, whether you may not declare, whether you may finance with equity, you may finance with debt or a combination, anything can happen. But if the company is having a good investment opportunity, then the value of that particular company will not be reduced. Am I clear, everyone? So how we can prove this is what the focus of this particular model. So hope everyone understood the idea behind this. To summarize, Gordon model and Walter model, in the formula itself they use the word D. In Modigliani-Miller approach, nowhere in the formula they will use the term dividend. Okay, dividend is no more impacting that particular share price. Hope everyone understood the concept clearly. So dividend is relevant for pricing, not relevant for pricing as per this approach. It is irrelevant. Therefore, Modigliani-Miller approach is also called as dividend irrelevance model. Dividend irrelevance model. Whether you finance by equity or finance by debt, then also value will not change. That's what we are going to discuss in a chapter called as a capital structure theories. With theories, capital structure theories, there you can explain or there you can understand whether you finance either with equity, you may finance either with debt, the wealth of the company will always remain unchanged. Clear? So that's what you want to tell also here. All the previous models like Walter and Gordon has emphasized that dividend declaration or non-declaration will necessarily affect the share price. Both these models has dividend in its formula, means a D. But model, to the contrary, states that dividend policy of company will not affect the shareholders' wealth or company's wealth. As per model, it is the investment decision that decides the wealth of a company. This can be understood through an example as under. Example, everything we will write separately, but hope everyone understood the basics of this introduction. Okay, you may ask a question, sir, what do you mean by this dividend policy of a company? Question will arise or not, or what do you mean by this investment decision? How to understand all these? That separate discussion will make. Copy the notes for introduction point number 1. Everyone in the class, please keep the heading clearly. Modigliani and Miller model, dividends chapter. What is the model? Modigliani and Miller model. I will make it full screen. Please copy down properly. Hope you completed writing the notes. Enough time given. So let's go to the next part. So see here. So now we completed the basic introduction. Now the example starts. First, listen carefully. Whatever it is written here in this example, all these concepts, okay? Till here, till here, till here. Okay, that means till part 3. That means up to here, I will explain now. Once I make my explanation, everything is completed. Later, I will give enough time for you to copy. You slowly copy down the notes. I am very strict about this particular area called as Modigliani Miller. Institute study material, if you open and see the Modigliani Miller approach, I think I have with me this one. Just a minute. See here, dividend irrelevance theory, dividends irrelevance theory, Modigliani Miller approach. To theory questions were given which are irrelevant for us. Those side headings we don't require. We require understanding of the concept. Their interpretation started here. Okay, one page they have completed and they started giving the questions. 2 pages they have given in the study material. I really don't know how student will understand with a 2 pages discussion on Modigliani Miller. If you can observe our notes, it has been totally in this corner. You can see the number, a small bit number is there na. 9 pages notes I have written on what? On Modigliani Miller without problems. Another 3 pages of problems will come. Means Modigliani Miller as a concept will be a 12 to 15 pages discussion. Very, very important. Okay, later you study CFA or CMA US. At that time, they don't ask you question answers and side headings. You should understand the model and its intention perfectly. Therefore, I have taken one example. Okay, sir, what is this example? I have taken one balance sheet. The balance sheet of the company is as under: liability amount, assets and amount. Equity 1000, debt 0. It's a zero debt company. Sir, if debt is there, what will happen? Nothing will happen. That's called as a financial irrelevance. What irrelevance? Financial irrelevance. That concept we will discuss in capital structure theories chapter. Assets are of 2 types: fixed assets and cash. 9,000 and 1,000. So totally 12,000. Number of shares are 1,000. Investment opportunity is 1,000. This is the basic structural information they have given. Don't write anything. First observe the information that is being given. I will give you 1 minute time. Observe the information. See the numbers. Because after seeing those numbers, we can make some analysis on the same. So see the numbers. Make analysis properly on the numbers given. Okay, now in this model we are going to understand what is an asset, what is this fixed asset, what is this cash. Sir, I already know what is a fixed asset. Accounts law we learn. That is bullshit literally. We don't require those understanding what you learned in accounts. This is financial management related fixed assets and financial management related cash. Number of shares and investment opportunity of 1,000 rupees we need to understand from financial management perspective. Okay, so before even going into the next part, first let me explain one point. Accountancy is a subject which undergo lot of assumptions, lot of expectations, lot of anticipations and estimates. So I didn't understand. Fixed asset is there. Okay, fixed asset. You will purchase a fixed asset. You will have a depreciation. Really, depreciation is an outflow, na? No. But that will be there inside. So accountancy will consider so many things which are not really what to say really undergo the process on fixed assets. Say for example, I said life of a fixed asset is 5 years. Today I purchase, fifth year completed, now fifth year it will blast. Life is only an accounting estimate. Means accountancy is always about imperfection. Then why accounts are for reporting purposes? For what purposes? Reporting purposes only accounts will be used. Okay, accountancy is always used for reporting. Means what? It's a general report. This is how the financial position of a company is. That's all. This is how it can be. It differs between two chartered accountants. If I prepare a P&L and balance sheet, okay, if I prepare P&L and balance sheet, my accounting assumptions, my accounting estimates, my conventional policies I follow, the standards how I follow, the assumptions I make in preparation will change. Am I clear or not? So therefore, try to understand. Depending on the person who prepare the P&L and balance sheet, numbers will change. In case of accountancy, financial management will be on a different footing altogether. I repeat in a simplified manner. Listen, this is not your accounting balance sheet. This is called as a finance balance sheet. Which balance sheet? Finance balance sheet. Sir, I didn't understand. Nothing you can understand in one go. First point number one. Modigliani Miller are two economists, okay, or there are two economists who has been awarded with Nobel Prize. Nobel Prize means it will not be given for small things. Nobel Prize will be always given to such people who literally changed the entire way of doing the things. Till that date, world has done the thing in a one way. They changed the way of doing the things. Then they will be given with a Nobel. Nobel Award will not be given generally. This is a Nobel Award model. Okay, so then what is this example? This example is not Koushik Mukhesh made example. This is an example taken directly from Modigliani Miller original theory. Modigliani Miller got a Nobel Award, na? Nobel Award means you need to write hypothesis, you need to write synthesis, you need to write analysis, you need to empirically prove that really what is there in theory is what practically affected. You need to prove that to the world. Then only you will be given a Nobel Award in the field of economics. These two people were given with a Nobel by showing this example they have done. Am I clear? By showing this example. 10,000 equity, zero debt, fixed asset 9,000, cash 1,000 are not Koushik Mukhesh prepared numbers. Modigliani Miller really in his Nobel theory, he has given these numbers. With this balance sheet, Modigliani Miller got a Nobel. Sir, with this small balance sheet, a balance sheet is small, discussion is very long. Okay, when I started reading the books on Modigliani Miller model, I concised everything what I learned. My knowledge of understanding the Modigliani Miller, I precisely concised them into a 12 pages notes. Okay, InShoot has given one page. I prepared a 10 pages almost, a complete comprehensive discussion on Modigliani Miller model. So observe, this balance sheet is the Nobel Award balance sheet. Okay, from this small balance sheet, they're done post-mortem like anything. They analyzed the balance sheet like anything. So how they have done, that's what we are going to see in this particular area. Okay, what is this balance sheet? This is not your accountancy balance sheet. This is a finance balance sheet. Okay, another name is also there. What is that name also? We will discuss. Okay, now listen carefully to the point. I will come back to our rough model. Okay, see here. I will rewrite the balance sheet. I will rewrite the balance sheet. See here. Liabilities and assets. Liabilities and assets. Okay, now see here. Fixed assets rupees 9,000 and cash 1,000. Next part. Equity 10,000. Debt is 0. Number of shares is 1000. Investment opportunity available to the company is 1000. Okay. Now, this is the base balance sheet that the question has given us. Okay. This is the base balance sheet the question has what given us. Now, listen carefully. What this model want to emphasize? Okay. What is the intention of this particular model? Let us try to focus on that particular issue now. See here. Modigliani Miller says that whether you declare the dividend, whether you do not declare the dividend, really it doesn't matter. Provided you have a proper good investment opportunity. Okay, provided you have good investment. Sir, provided you have investment opportunity or good investment. What is the good? That also has interpretation. Good also they interpreted. What do you mean by the word good? In that investment, good investment opportunity. What is the good? That's what we are going to analyze again. Okay, first focus on the concept. This is a balance sheet. Liabilities and assets were given. Asset side fixed assets 9,000, cash 1,000, equity 10,000, debt 0, number of shares 1,000, investment opportunity is 1,000. Okay, now see here, step by step, let us move on. Our intention is to prove whether you declare dividend, whether you do not declare dividend, wealth of the company will remain the same. Two situations can happen. Situation number 1. Situation number 2. Let us focus on situation number 1. Okay, now see here. Situation number 1. As per situation number 1, dividend not declared. Here, dividend is declared. Dividend is declared. Dividend not declared. Let us first focus on that. If dividend is not declared, what will happen? The cash, whatever is available, this 1,000 rupees, will be used to service this investment opportunity. Means what? How much investment opportunity is available for the company? 1,000 rupees it want to invest in fixed asset. Sir, 1,000 means 1,000 crores. You can take like that. Or you can take 1,000 lakhs. You take 1,000 trillion. You take 1,000 billion. I take a simplified number. Okay, Modigliani Miller has taken the same in dollars. Dollar 9,000, dollar 1,000, dollar 10,000 you have taken. I am teaching in India, na? So let me be like an Indian in India. So therefore, I took rupees. 9,000, 1,000 also not Koushik Mukhesh number. These are really Modigliani Miller's numbers. Okay, for the thesis they submitted for the Nobel Award, they have submitted these numbers. Okay, let us focus now. Please don't lose the focus on the concept. Understand point by point very clearly. Okay, fixed assets 9,000, cash 1,000. How much investment opportunity is available? 1,000 rupees investment opportunity is available. Now, I don't declare a dividend. Means if I don't declare dividend, cash of 1,000 will be with me. The retained earnings of 1,000 rupees will be used to used to service the investment opportunity. So therefore, this 1,000 rupees will be utilized to service the investment opportunity. What will happen if dividend is not declared? Cash will get converted into fixed asset. So the balance sheet will look like this. Okay, fixed assets already 9,000 is there. Now I invested extra 1,000. Totally it will become 10,000. Okay, totally it will become 10,000. Cash will become 0. I didn't touch anything on the liability side. The equity will become 10,000. Now tell me, wealth means total value of this equity. Now tell me, the value of the equity, the wealth of the company before even using this 1,000 is 10,000 rupees. Now I utilized that 1,000 rupees to invest in fixed asset. Now what is the value of this particular equity? Wealth of the company is how much? 10,000. So if you don't declare a dividend, value of the company will change. The wealth of the company, equity value of the company will change or will not change. If you don't declare dividend, will not change. Okay, rule number 1, thumb rule. Next, number 2, dividend is declared. First situation, dividend not declared. Second situation is dividend is declared. If dividend is declared, what will happen? If dividend is declared, this cash will become zero. This cash will become how much, sir? Zero. This cash will become zero. Then what to do? I have to get this investment of 1000 through new issue of shares. I repeat one more time. How much cash is there in my company? 1000 rupees. How much investment opportunity is there? 1000 rupees. Now this 1000 directly I can utilize for investment opportunity. Am I clear or not? Yes. However, I want to declare a dividend. I want to declare dividend. So if I declare dividend, dividend should be paid only in cash as per Companies Act. Na? So that 1000 rupees of cash settling on the assets side of the balance sheet will be paid as a dividend. So the cash will become zero. So see here, my balance sheet look like this. Liability assets. Fixed assets 9000, cash 0, equity will take the balancing number 9000, it will become how much? 9. That's why I'm not writing accounting balance sheet, I'm writing FM balance sheet, financial management balance sheet. Okay, so equity is how much? 9000. Okay, some meaning of this 9000, why I am taking this number here, everything I will explain. Just wait and listen patiently. Listen to the entire discussion for 2 hours. The entire theoretical discussion once completed, problems just like that you can do. So before even going into that, how much is the worth of fixed asset? 9000. That is same. Cash of 1000 is not there. So therefore, what is the wealth of the company? For a 10,000 worth the company now fall to 9000. Same is reflected in the form of equity. Okay. Let's assume that liability is only a balancing figure. That means we will add this and we will take the same number. Why? We will discuss everything in detail later. Listen carefully. How many shares are there? Number of shares is 1000. So tell me, what is the market price per share? What is the market price per share now? 9000 divided by 1000. It will become rupees 9. It will become rupees 9. Okay. Now, listen carefully. My question is very clear. Listen first. In the second situation, I declared dividend. I didn't declare dividend. I declared dividend. Because of declaring dividend, the market value of this company from 10,000 has a fall to 9,000. And market price per share from 10 rupees has now fall to 9 rupees. Okay. Now, sir, you said that whether you declare dividend, you don't declare a dividend, whether whatever you do, the wealth of the company remains the same. That's what you said at the beginning. But here the wealth of 10,000 has reduced to 9,000. So wealth is changing now. I said whether you declare dividend, whether you may not declare dividend, wealth of the company do not change provided you have a good investment opportunity. In this balance sheet, investment opportunity is not considered. We considered only paying the dividend. But we need to prepare another balance sheet paying the dividend and taking new investment opportunity also. Once you do both the things and prepare a balance sheet, wealth again remains the same. That's what we are going to prove now. Okay, before going into that, so this concept I didn't understand. Some people may tell that, so I will explain in a decently a different way. Okay, listen, there are two concepts. One is cum dividend share price. Second one is ex dividend share price. Cum dividend share price, ex dividend share price. Okay. Now, I will explain in a different way and I will then come into the financial management. This example I used to give also in law paper. The same example I will import and I will also explain here. Okay. Listen carefully. Point number one. A person is having a cow. Okay. A person is having a cow. He took that cow to a cattle sale. Means cattle exhibition will be conducted. Exhibiting the cattle, people who are in agriculture will buy the cattle by paying good amount of money. These goats, sheep, for that case, buffaloes, oxen, bulls, and cows, everything will be gathered. Cattle exhibition will be conducted. There in that cattle fair, they will sell that particular cattle. Okay, listen carefully. A person is having a cow. He brought it into the market. Exhibition started. After some time, one person came to him. He asked him, I want to buy this. Okay, I want to buy this. So I am the person who want to buy. You are the seller. I asked you, I want to buy this. How much? You said 80,000 rupees. I said, Are there it is only 50,000. Same breed, same cow. I thought you will be telling a 2-3,000 lesser than that price I want to buy. Suddenly you are raising the value and telling that it is 80,000. Normally everyone is charging 50. I thought that 50 itself is very big. Maybe you give 2-3,000 discount, you are heavily charging 80,000, 30,000 difference is there. Then I asked this question to you. Then you said that, Mr. Koushik Mukhesh, what the cow I have with me, that is not a normal cow. Then I asked, if not a normal cow, what it is? It's a Kamadhenu, ah. Okay, it came directly from God. Ah. Then you said, no, this is having a calf inside it. Means it is due for a delivery. Simply to tell, this particular cow is not a normal cow. It is having a calf inside it, which will come in another next 1 month. If it is a female cow that comes out, it will become a milking cow. If it is a male cow, you can use it for agriculture, cultivation. Okay, that means both sides you are having an advantage because of a baby inside the cow. We call it a calf. So I asked you, you give a value of 80,000. I asked why. Then you said me, Koushik Mukhesh, you are not buying a cow, you are buying a double benefited cow. Means if you buy this cow, in another 1 month, calf will come out. Then you are having two cows with you. There is an advantage or not? If you want to buy two cows, really it will cost you around 1 lakh, 1,05,000. I am telling both are available at 80,000. So then you thought that, okay, then I'm ready to buy. I paid 80,000 and I bought it. Okay. As per the deal, 1 month this cow gave a calf, male or female, whatever the case may be. It came out. Now the calf came out. Now this cow is there now. I want to sell this. Okay, main cow is there. I want to sell this to some gosala. Okay, it became old age. So I want to sell it to a gosala. Gosala means it's a safe place for them to live. So I said that I will give it to a gosala. Gosala person came to me to buy. I said that he came to me. Now I am the seller. He asked me, Koushik, what is the price of this cow? I said the price of this cow is 80,000. He said 80,000? Arey, market people are getting only at 50,000, 45,000 like that. Why you are charging 80,000? I said this is not a normal cow. This is having a calf inside it. Calf inside it, it is having in the past, not today. So therefore this is a normal cow only now. So therefore you can't sell it at 80,000 because already calf came out. Clear everyone? So therefore when the calf is inside the cow, cow value will increase. If calf comes out, the cow value will again fall. Same concept apply also for a share. Okay, share, whenever the board of directors announces that they are going to declare a dividend in the coming AGM, they declare today. AGM is conducted after another 30 days. In this 30 days gap period is there na? In this 1 month period, price of a share will not just include the price, it will also include dividend inside it, because a person who sell the share in this 30 days period, in the meanwhile if he sell, he is not just selling a share, he is selling a share with the dividend which will come in another 1 month. Means he is losing that opportunity also or not. Therefore he should charge not only for the share, he should charge for the share and the dividend what he is foregoing. Okay, so first example is then in our cow, it is a cum calf cow. This is a cum dividend share. Okay, so cum dividend share. Now Modigliani Miller said that the price of the share, okay, previously what is the wealth? 10,000. How many shares are there? 1,000. So 10 rupees is the each share value or not? That is a cum dividend share price, rupees 10 minus dividend. Dividend is declared or not? Yes. Once the dividend is declared, the calf came out. The dividend came out. So how much dividend? 1,000 rupees cash for 1,000 shares. So how much? Rupees 1. So what is the ex-dividend share price? Rupees 9. Means a share which would have been traded at 10, because of paying the dividend, the share price has a fall to 9. That's how you have to understand this balance sheet model. Hope you can understand why I have written MPS as 9 now. If you didn't understand this explanation, at least understand this explanation. Okay. Now, sir, price is fall. Sir, I said wealth will remain unchanged, not the price. Price may become 6 rupees also. I said overall wealth will be same. Overall wealth will be same. How? I will prove now. So, and moreover, I said wealth will be same if company makes a good investment opportunity. Company makes a good investment opportunity. So, what does it mean? Let's see the screen. Already, how much fixed assets are there? 9,000. I paid dividend, I didn't pay the dividend. I paid dividend. I paid dividend. Price became 9. Now, at this 9 rupee price of the share, I need to make a public issue. Public issue to raise how much money? To raise rupees 1,000 crores or something. I want to raise this 1,000 by issue of shares. So tell me, amount to be raised, how much? 1,000. What is the market price per share? 9, not 10. Why? Already we declared dividend, price became 9 rupees. Now we are going to public issue. Now we are going for public issue. Okay. You should go for public issue after declaring dividend. 9 rupees. So number of shares, 1,000 divided by 9. How much? 111 shares. How many? 111 shares. So you will issue 111 shares. 111 shares at how much? 9 rupee. 111 into 9 rupees. 111 into 9 rupees. 999 or 1,000 as a number. Okay. So now tell me. Fixed assets is 9,000. I am raising how much on a public issue? 1,000 I am raising. So fixed assets again I will buy with that cash available. How much it will become? 10,000. So equity value will be, how many shares are already there? 1,000 plus how many new shares I am issuing? 111. What is the overall price of the share? 9. 1,000 plus 111, totally 1,111 into 9, 9,999, or you can take it as 10,000. So now tell me, again the wealth has become 10,000 like this. From this, what you have to understand, whether you don't declare a dividend, whether you declare a dividend, wealth of the company will remain unchanged. Wealth, overall wealth will be same. Price of the share may fall to 9, but overall wealth will be maintained. So what is the difference between a price and wealth? That we are going to discuss in the next stage. Okay. Hope everyone understood the ideology to some extent. Okay. So the point is, Modigliani Miller approach want to focus and say that whether you declare a dividend, whether you do not declare a dividend, the wealth of the company will not change. Okay. Wealth of the company do not change. If you do not declare a dividend, cash becomes fixed assets. If you declare a dividend, stages will come. First, declare the dividend. Dividend will go. Company will become a lesser wealth company. Immediately, you make a public issue. Okay, you will get the cash. That cash will be converted into fixed assets again. Okay, number of shares will increase. Issue the shares at the market price after declaring the dividend, rupees 9. So this is what we have seen up to here. Hope everyone understood this. So the point is, as per Modigliani Miller approach, whether you declare a dividend, whether you do not declare a dividend, wealth of the company will not change. This is a proof. Okay. Same things whatever you have seen here, I put it in a decently written format this way. Balance sheet of a company. If this company want to take up investment project, it has two options. Option 1, invest the cash of 1,000 for investment. Then what will happen? Cash of rupees 1,000 will become investment in fixed assets. Option 2, declare dividend with the cash available and raise the new equity. So cash will be paid as dividend and company will issue new shares in initial public offer at X dividend price. As per option 1, the share price is as under. Share price before dividend 10 rupee. Share price after investment will remain unchanged because cash becomes an asset and balance sheet and wealth will remain unchanged. But as per option 2, this is important. Share price before dividend 10 rupee. Share price after dividend, come dividend price is 10. Dividend per share is 1. X dividend price will become 9. This share price is shared by 1,000 shareholders and the wealth will become 9,000. Wealth will become 9,000. Now, wealth reduce. Now we have to make again it 10,000. What to do? Investment opportunity. Once dividend is declared, rupees 10,000 worth company will become 9,000 worth company. Now the share price of company is 9 and at this price, company will make public issue to make investment of 1,000. Number of shares to be issued is 111. Okay, summary of wealth. Okay, the summary of wealth also I will explain. Later you can write the notes. See, sir, I said wealth will remain unchanged. Wealth will remain unchanged. So, proof. We will now show the proof that wealth will remain unchanged. See here. Dividend not declared. Dividend declared. Wealth will change or will not change? Will not change. Whose wealth? Company wealth or shareholders wealth or both? On wealth of company, on the wealth of shareholders. On the wealth of company, on the wealth of shareholders. Okay, first, dividend is not declared. What is the wealth before? Wealth, not price of share. Wealth means total 10,000. Okay, if dividend is not declared, cash will become fixed asset. Again, wealth after is rupees 10,000. Unchanged, changed, unchanged. Now let us see the wealth of a shareholder. Okay, wealth of a shareholder. Now answer my question clearly. Tell me. A shareholder is holding, say for example, 100 shares. How many shares? 100 shares. Or let us say he is holding 10 shares. In this overall 1000 shares, 10 shares a shareholder is holding. How many? 10 shares. I will do one thing. Let's take some, at least a good number, 100 shares. A shareholder, so you take 23 shares, you take 38 shares, anything, answer will be same. I'm taking decently 100 shares. Let us say, for example, one of the shareholder is holding 1000 shares. Okay, now see here. His wealth before is how much? 100 shares of 10 each. How much? 1000 rupees. Wealth after. What is the share price again? If dividend is not declared, the share price will tend to remain the same. Same 100 shares will be there into 10, that equal to rupees 1000. That equal to rupees 1000, because just the cash which is there with you is converted into assets. Now, dividend is declared. If dividend is declared, wealth before 1000 shares of 10 each, 10,000. Wealth after 1111 shares of rupees 9 each, 9,999. I rounded off to 10,000. Okay, so 10,000 remains the same. This is unchanged, change the unchanged. This is unchanged, change the unchanged. Shareholders wealth. This is very important. Wealth before. Wealth before. How many shares a shareholder is holding? 100 shares into 10 rupees 1000. Wealth after paying the dividend. After paying the dividend, 100 shares only I will have, because new shares are issued to new persons, not to us. We have the same 100, but the share price has fallen to 9. So how much is the wealth? 900. Like this you should not think. Dividend declared, I said, means cash I would have received or not, 1 rupee for each share. 100 shares into rupees 1 equal to rupees 100. So what is the total wealth again? The total wealth is 1000. Means what you have to understand from this, the moral of the story is wealth represents overall assets of a person. Share price means only share price. Here really if you take share price, my wealth of share wealth came to 900, but I compensated it in the form of a cash wealth which I got 100 rupees, and the total wealth of that particular shareholder holding 100 shares which is 1000 before, now again it is settled at same 1000. Yeah. So therefore, whether you declare a dividend, whether you do not declare a dividend, the wealth of the company and shareholders changed. Okay. So this is what he has shown. Summary of wealth. If dividend is not declared, impact on company's wealth, impact on shareholders' wealth. Let's say holding 10 shares. I have taken 10 shares example. So same thing. Clear? So therefore, model tries to explain that if a company has an investment opportunity, it will surely take it whether or not dividend is declared. If company distribute dividend and and it raises the required funds through new issue. Okay, so it raises the funds through new issue. This will not affect the company's wealth as 1000 goes out as dividend and come back as a capital. The same wealth which is shared by 1000 shares will now be shared by 1111 shares, therefore 9 rupees per share. In case dividend is declared, the shareholder experiences both joy and sorrow. Joy because he received dividend, sorrow because the share price dropped. The dividend benefit is offset, means exactly knocked by the capital loss. Capital loss means 9 to 10 rupee share became 9 rupee. For that I will cry. But compensating, I am getting 100 rupee dividend. Na? Both will offset each other. Okay, so the super summary is Modigliani Miller model concentrates on dividend irrelevance on wealth of the company as well as shareholder. Modigliani Miller says that wealth of company or shareholder will remain unchanged if company has a good investment opportunity. Okay, here if you observe, prior to declaring the dividend, wealth of the company is something 10,000. Dividend declared, it became 9,000. But again, it came to 10,000 because you made a investment again. Hope everyone understood the logic clearly. Okay, when you are writing, write with understanding. Don't just mechanically copy. I will give 15 minutes time. Slowly you copy step by step. Okay, step by step you copy. So hope you have completed writing. So let us move on to the next part. So now we have completed up to here. So MM model primarily concentrates on a mode that the dividend decision is least important provided the company is having a proper investment opportunity. Now everyone will get a doubt. Sir, what is this small balance sheet, sir? For this, how they awarded with the Nobel? A question will arise. Okay. So generally person will get a question. So the question that arises is, with that small balance sheet, how they get convinced? The person giving the Nobel Award, at least he should get convinced with the logic. Na? So on what basis they would have given? So listen first. Point is, this is a great thinking. Okay, easy thinking only, but it's a great thinking. So how they made this? That's the next part of our discussion. This is more difficult to understand. So please concentrate on the entire issue properly. Now we are making third part discussion. What is this? Balance sheet interpretation. What is this? Balance sheet interpretation. This is very important because so many issues we have to discuss. Okay. So these many issues we need to discuss. After that, we will see the formulae. After that, the derivation. After that, the problems. Okay. In this, what is the easy thing? Doing the problems is easy. Okay. What is the difficult? Understanding the concept is difficult. Okay. So let's see. So next thing that we are going to do is, just a minute, let me add the pages. Okay, see here now. So the point that everyone has to understand is, there is a balance sheet. This balance sheet is having liabilities as well as assets. So assets of this particular company are fixed assets 9,000, cash of 1,000, equity of 10,000. Original balance sheet I have given you. Sir, what is this fixed asset of 9,000? Historic cost, book value, WDV, what value? None of these. That's why from the very beginning I've been telling you, this is not your accounting balance sheet. This is the finance balance sheet, also called as fair value or market value balance sheet. It is correct to call it fair value balance sheet. All generally you can call it market value balance sheet, people call, but real meaning is fair value balance sheet. Sir, I didn't understand what is this fair value balance sheet. Sir, I will explain first. After that, you pass your own conclusions on this. See here. The fixed asset of 9,000 written here is not the value of the assets. Okay, it's not the total of all the assets. Company is having land and building, plant and machinery, furniture and fixtures. So many assets are there in the company. All these WDV put together is equal to 9,000. Wrong. All these costs equal to 9,000. Wrong. All these book values equal to 9,000. Wrong. Then what it is a question now. Okay. See here. Point number one. I started an institute. Say for example, I started a physical institute. In this physical institute, I am having an iPad. Okay. I am using a device called as a iPad for writing everything. I am having a calculator. Okay. I am having my camera. Okay. I am having my equipment laptop. Okay. I am having other connecting accessories and peripherals. All these put together, okay, these are all assets. iPad is an asset. Laptop is an asset. My table is an asset. Furniture is an asset. My camera is an asset. Am I clear? So everything is an asset. Okay, everything is a asset. Okay, now listen carefully to the point. If a person asks me what is the value of this particular laptop or what is the value of this iPad, if they ask me, I will tell the value of this iPad is, okay, the value of this iPad is, say for example, I say 1 lakh. Okay, 1 lakh. 1 lakh is what? 1 lakh is the price of this laptop. Of this iPad. I'm not asking the price or cost. I'm asking the value. Value means what? Value means, for example, Koushik Mukhesh will earn some amount of money during a particular year from classes. Okay, some amount, X amount. In that total amount you get from CA foundation, CA inter, CA final from three subjects each. So all this put together, how much revenue I get per annum? I will take some number. I said 60 lakhs. I said 1 crore. So this is the amount that I will get in a year. Now I want, in that 1 crore rupee revenue I make every year, how much revenue is coming because of this particular iPad is a question now. Okay, from this iPad, because of having this iPad, how much value I am getting in the total value I got? I repeat once again if you didn't understand. See here. What is the value of an asset? We learned in the first classes. Value of an asset is present value of future cash flows discounted at required rate of return. Okay. Okay. Now listen carefully to the point. So the value of an asset is the present value of future cash flows discounted at a required rate of return. So the question arises, if that be the value of an asset, I will take a balance sheet. Fixed assets, I am having the following fixed assets: land and building or property, the building in which I live, okay, plant and machinery, or for that case I don't have a plant and machinery, I will write computers. Next one, peripherals. Okay, this is my situation. Now my question arises, property, this building is there, okay, this particular building or this particular room, whatever I call. Say for example, this will be cost, I'm not talking about. My question is, this particular room is a place to record the lectures. Means there must be a place for me to record my lectures. For that this room will be helpful. Means if I don't have this studio room with me, I cannot record these classes. If I cannot record these classes, I cannot sell the classes. If I cannot sell the classes, I can't get the revenue. Revenue means a cash flow. That means if the destination is the cash flow, source is the room. Okay. Now listen carefully. Say for example for CA final SFM. Say for example I charge 10,000. CA final SFM and stock markets analysis. In-depth examination, in-depth classes, not exam oriented. In-depth classes are there, including trading sessions, everything. So 10,000 rupees for CA final SFM. Now listen carefully to my logic. In this 10,000 fees that I am collecting from the student for SFM for a final level, how much a percentage of this 10,000 means in this 10,000, how much amount you will allocate to the property? I repeat, what is the value of this property? I want fair value of this property now. What is the fair value of this property? Present value of future cash flows discounted at a required rate. Okay. This particular property will give any cash flow to me. That means I am residing in this property. I am giving this property on rent. I am residing in this property. I am not giving it on rent. If I can give this property on rent, the present value of all the future rental cash flows will be the value of this property. Easy to understand. But I am using this property to record my lectures. That means this is property which is rented, the property which I am using. So if I have this studio room, I will record the classes. Those recorded classes I will sell and revenue will get generated. Okay. Now my question is, if I don't have this property, if I don't have this studio room, I cannot record the classes. No classes, no sale. No sale, no cash flow. Next, computers. I have a room, but I don't have a computer to record the lectures. Now full infrastructure is available with me. Because of this infrastructure, I can record the class. I have an empty room. I don't have a green screen. I don't have any other infrastructure or equipment to record the classes. In such a case, what I will do with the property? This property is there. This property I didn't give on rent. It is a self-occupied property. In this self-occupied property, I am conducting the lectures recording. Say this studio room is a property. Okay. So I am asking a question. What is the value of this property? Present value of future cash flows this property generates. Okay. Discount rate, a required rate will give the value of this property. What is the value of an asset? Again, I am asking present value of future cash flows discounted at required rate. So what is the value of a property? Present value of future cash flows. This property will give me discount rate, a required rate, whatever the rate. If you take a loan and took this property KD or else KE or else KO, if both are involved. Okay. Now this is the answer. But answer, how much this property is generating revenue? I am giving this property on rent, self-occupied. It's a self-occupied property. Self-occupied property means I am not giving it on rent. I am using for me. Therefore, what is the cash flow that it generates? I can't say specifically this is the cash flow it generates because I'm not giving it on rent. I'm using this property. Second. So, point number one, property is there. If this property is not there, studio will not be there. Studio not there, recordings cannot happen. Recordings can't be made, I can't sell the classes. If I can't sell the classes, no cash flows for me. That means the destination is the cash flow, but the origin of the source is property. Number one. Number two, computers. I have a property. I have what's a property. So I have a room, I have a studio room, but I don't have studio. Simply to tell, I don't have a laptop, I don't have infrastructure, okay? I don't have computers, I don't have cameras, nothing is there. Now tell me, I am using it for self-occupied. I am sleeping every day, waking up, eating, sleeping. Now tell me, will this property generate any revenue without a computer? I am talking about classes. If I want to run a class, only property is enough, only studio room is enough, studio room with computers is enough, studio room with computers is required. So this computer is one of the element which is helping me to generate revenue. I mean the cash flow. Number three, peripherals. Camera, okay, chargers, okay, power connections, air conditioning systems. All these things are peripherals. All these things are what's are peripherals. So peripherals means attachments to the main computer system. Main computer system is a asset. For that other assets will collaborate. Like I have to attach a camera, I have the wiring system, okay, I have a printer, I have a Wi-Fi connection. All these are peripherals. Without these peripherals, I can't give the classes on sale. I want to upload to the upload to your Google Drive means every time I should have my Wi-Fi. So all these things also will help me to sell the class. That means my class sale is my cash flow. But to generate this cash flow, I require a studio room. I require proper computer systems and infrastructure. I need peripherals. Now answer my question clearly. All these three independently will generate revenue. All of them put together will generate revenue. All of them will put together generates revenue. Simply to understand how much in this fees of 10,000, how much you are collecting in the form of property, or because of property in this 10,000 how much revenue is generated, because of computer in the 10,000 how much revenue is generated. That means 10,000 is the fees I charge for SFM. In the 10,000 for property, because of property how much cash flow is coming, because of computer how much cash flow is coming, because of peripherals how much cash flow is coming. You can't tell like that because all the three are very important. How much property is important, that much computers and infrastructure is important. How much property and computer infrastructure is important, wires and connectings things are also so much important. That means all of them put together only will have a value. Independently, none of them will have a value. Simply to tell, I have a computer system, no green screen, nothing, no infrastructure, no peripherals. Only computer system is there. Can I do recording? No. Property should be there. Only property is there without computers. Can I record the class? No. I have property and computers, but I don't have connecting wires. So these wires are also equally important to record a lecture. I have an iPad, I have a laptop, no connecting peripherals are there, no Wi-Fi, nothing is there. Then I have to record and see. Or even that also I can't do because without peripherals, how can you record anything? You cannot. So therefore, in this 10,000, this 10,000 rupees cash flow, what I am generating for me is because of property or because of computers and infra or because of the peripherals or because of all of them, which is more important, all are equally important. Okay, individually, for example, this wire is there. Without this wire, can I record? No. Then tell me how much cash flow this wire is generating. I can't tell. How much cash flow this calculator is generating. I can't tell. But without calculator, I can't conduct FM classes. Okay, that means this is useful, but because of this cash flow in this 10,000, 28 rupees is coming because of calculator. Can I do like that? That means independently you cannot value each asset. I will not call this as property. I will not call this as a computer. I will not call this as peripherals. I will call this as Koushik Mukhesh Hyderabad project. Okay, that means all of them put together only will have a value. Individually, no asset can generate any cash flow. Hope everyone understood. Okay, same thing let us apply to a big company. There is a manufacturing company. There is a factory building. There are plant and machinery. There are other office administration things. There is a selling and distribution hub. There is a office administration hub. HR departments are there. All of them put together will generate revenue. I have a big factory building. No machinery inside. Will sale happens on the, will finished good get manufactured? No. That means to manufacture a finished good, I require two things: fixed assets and current assets. All of them put together I call asset. Okay, all of them I call it as asset. So what is the value of any asset as per SFM? As per FM, present value of future cash flow discount at a required rate. Okay, now listen carefully. I want to manufacture textile cloth. Cloth will get manufactured from a raw material called as a raw cotton. Raw cotton, they will put in a machinery. Step number one. There, they will unseed everything. They will de-seeding. De-seed means cotton balls will have a seed now, they will de-seed everything. Then it will go into a stage called as a polishing stage, where the dust and other things attached to the cotton balls will be removed. Later, third stage, that means machinery number 1 will de-seed. Machinery number 2 will polish. Machinery number 3 will be doing the cold pressing work. Machinery number 4 will be doing the threading work. Machine number 5 will be doing the clothing work. And machine number 6 will be doing the dyeing work, color dyes. And machine number 7 will be doing the stitching work. Machine number 8 will be the finished product. Packing, everything will be done. That means how much machine 1 is important, same machine 8 is also important, or 7 or 8, whatever the case may be. That means in this entire process, which machinery is more important? If a person asks, what you will tell? Everything is important because my total process is interlinked to each other. Machinery number 1 is important, 2 is important. Without 2, 3 cannot start. Directly from 1 to 3, a process cannot begin. So machinery number 1, 2, 3, 4, 5, 6 and 7. Let's say 7 machineries are there. In this, every machinery will do its own work, such that the finished product will be available for sale. From this, what we have to understand, if any person asks, what is the value of, not cost of, what is the value of machinery 1 in this process? What is the value of any asset? Present value of future cash flows a machinery will generate. So, what is the present value of the future cash flows generated by machinery 1? Machinery 1 can't generate any cash flow. Machinery 1 with the help of 2, 3, 4, 5, 6 and 7 will generate revenue. How much value the machinery 4 is having? Present value of future cash flows which machinery 4 will give. Machinery 4 will not generate any revenue. Machinery 4 along with 1 to 7 will generate revenue. That means individually, in companies generally, you can't value the assets. Individual valuation is a foolishness. Therefore, here the word fixed assets of 9,000 crores, whatever is written, is not value of any one asset. It is a value of entire project. That's why always you need to understand, in companies and outside market, people call them project. Project means group of all the assets working together. That's called as a project. Fixed asset here does not represent, okay, fixed asset here does not represent just the cost of fixed asset. It is the value of the project as a whole. It is not value of individual assets inside. It is a value of entire project. Okay, so this is one part of the discussion that I need to make on this issue. So in this example balance sheet, what Modigliani Miller actually taken, Fixed assets don't represent WDV or cost. It is the value of all the assets as a project. Okay. Okay. Now, listen carefully. Let us now understand fixed assets from or assets from accounting point of view and financial management point of view. Okay. Modigliani Miller got Nobel Award for financial management, not for accountancy. Do you know accountancy don't have Nobel Award itself? Okay, Nobel Awards will be given to certain fields. Okay, peace will be given a Nobel, Mother Teresa. Science will be given. Economics will be given. Okay, financial management is a field of economics, one of the branch of economics. Okay, economics is one of the biggest branches in this world where it will factors in two important concepts. One is financial management, another one is statistics. Therefore, in these two fields, Nobel Awards will be given. For accountancy, no Nobel Award, sir. For accountancy, there is no concept of Nobel. Nobel Awards will not be given for accountancy. Sir, why, sir? Enna pakshapatam, sir? Because the simple reason is it has a lot of nonsense assumptions inside. Nonsense assumptions will be there in accountancy. Therefore, accountancy has no field on Nobel. Nobel Award will be given for financial management, not for bloody accountancy. Okay, accountancy is a reporting. You will project and you will show that this is how it happened. That's all. Post-mortem report. For post-mortem, what scientific research is required? Okay. For medicine, scientific research is required. That's why medicine has Nobel. Post-mortem don't have Nobel. Likewise, accountancy don't have Nobel. Financial management is having Nobel. Why? Accountancy already happened events you will write on a paper. Financial management, present value of future cash flows. You will project a future and do. So that astrology has a Nobel. Not for the happening things which have already been done. Okay. So anyway, let us understand this. There is a fixed asset or there is an asset. How accountancy will deal with it, how financial management will deal with it, let us try to understand. In accountancy, what is a fixed asset? Fixed asset means cost of fixed asset, means purchase cost. Simply, in our example, go back, think. How much fixed assets are already there? 9,000. How much cash is there? 1,000. Okay, 1,000. Say for example, if I don't declare a dividend, what will happen? Cash will be invested in the fixed asset. Now tell me the accounting entry. Fixed asset account debtor to cash. How much? 1,000. That's all. On the balance sheet, 1,000 they will show. But financial management will not show like that. Financial management will tell that. Just a minute. Okay. Financial management will tell three things. First point number one. What you want to value? I want to value fixed asset. Okay. I am using the word value. I want to value the fixed asset. Okay. What is the value of any asset under FM? Present value of its future cash flows. Let's say, example sake I am taking. It is a perpetual project. It is a perpetual project. Means perpetual project means project which will be there forever till the company is there. Okay. Tata Iron and Steel company is there here. You may ask a question, sir, perpetual project. Practically is it possible? Tata Iron and Steel Company Limited is there. Na? That company will do which project every year? Iron and steel. Till how many years? Till it live. Till the company is there, it will do only iron manufacturing, iron and steel. Therefore, it's a perpetual project. Okay. Now listen carefully. I want to start a project. I want to start what's a project? Project I call fixed asset. From today, remember, financial management, whenever we call asset, asset means a project. Project means one asset or two assets, all the assets put together. All the assets put together. Can you individually value any asset inside? Cannot value. Cannot value because each asset is interdependent on other assets. Clear everyone? I repeat once again. My class fee is 10,000. Okay, my class fee is 10,000 or yearly I will earn 1 crore rupee on classes. Not interview, final foundation, everything. Wherever I take, I earn 1 crore per annum. Okay, on an average. 1 crore. In that 1 crore, how much you got because of this building means I can't tell. How much in that 1 crore, how much revenue came because of camera? What is the bloody question? Because of camera, how will you get revenue? Am I clear or not? Because of this iPad, how much revenue in that 50 lakh, how much amount is coming because of this iPad, how much is coming because of this laptop, how much is coming because of this wire, how much is coming because of pen drive, how much is coming because of Wi-Fi. Like that you can't ask, but all of these put together will give me that 1 crore. Definitely, that is sure. Okay, without any one of these, I can't do the classes. But individually, I can't value any of them. Therefore, we don't call them as assets, we call them as a projects. Okay, we call them as what's a projects. Okay, now, so value. I want the fixed asset value, means project value. Fixed asset means project. Okay, now listen. In FM, people won't call it in the way in which we do. Okay, as I already said. So let us first focus on understanding the concept of this asset. Okay, let us see. Fixed asset and fixed asset. What is the value of asset? Present value of future cash flow. When I say perpetual project, present value of perpetual cash flows is cash flow per annum divided by required rate. If you remember, beginning formula. Okay, so how much you are investing, how much cash you are investing in the project. Already 9,000 crores of fixed assets are already there. New one, how much excess cash is there you are putting in investment? 1,000. So 1,000 crore you are investing. This 1,000 crore has to give some cash flow return or not. Let's say, for example, it is giving a R is greater than KE, R is less than KE, sorry, equal to KE, R is less than KE. Let's take three situations. Sir, what is the meaning of R greater than KE? R greater than KE means this particular project will generate a cash flow. In percentage terms, return on investment, this is investment. Return on investment is 12%. But how much shareholders are expecting? 10%. Okay, cash flow per annum divided by RR. How much is the cash flow per annum? This is a perpetual. 1,000 I invested, every it will get 12% return. So take calculator. 1,000 into 12%. How much? 120 divided by how much? 10% divided by 10%. How much? 1,200. Okay, now answer my question clearly. How much is the value of this particular asset? 1,200. What is the cost of the asset? 1,000. 1,000 is the cost. 1,200 is the value. But accountancy lo 1,000 they will consider. Real worth they will not consider. They will consider the cost. But financial management considers the values. Okay, what is the worth of that asset to you? That is important for me. What is the cost is irrelevant for me. So how much is helpful for you? Personally, what is the value of that asset to you is important for me. Not how much the cost is in the market. So 1,200 is the value of this asset. But the cost is only 1,000. That means if I purchase this asset at 1,000 in the market, it will generate me a cash flow of 1,200. Means 200 rupee excess cash flow I am getting out of it. That's called as positive NPV. Capital budgeting chapter we will discuss much in detail. Okay, next. Sir, exactly R equal to KE, sir. 10,000 you are investing. R means what? Return on investment. Return on investment. How much you invested? 1,000 you invested. Cost is 1,000. How much return it is generating? 10%. How much shareholders are expecting? 10%. So 100 divided by 10%, rupees 1,000. Rupees 1,000. This concept of 1,000 is called as good. Sir, I didn't understand. Modigliani Miller approach, the beginning of what I said, a company, whether it declare a dividend, whether it may not declare the dividend, the wealth of company will remain same provided the company is having a good investment opportunity. Good investment opportunity means an opportunity where a company can generate that much return which is exactly equal to KE. Sir, in the first case I am generating more than KE. That's called as a best investment opportunity. This is good. If it is less, it is called as substandard. It is called as what's a substandard. Therefore, always whenever company tries to invest, You should invest only in such a place where R should be either equal to KE or R should be either greater than KE. Good means at least it should be equal. How much shareholders are expecting? 10%. How much you are getting out of this project? 10%. Decent. You are giving what they expect. How much shareholders are expecting? 10%. How much return the project is generating you? 12%. Or you are giving better than what they expect. Third case. How much you invested? 1000. How much company is giving? Return is what? 8%. How much shareholders are expecting? 10. Means 1000 into 8%, 80 divided by 10%. So tell me, 80 divided by 10%. How much? 800. Now tell me, what is the cost of the asset? 1000. But what is the value of the asset? 800. Now tell me, if this case is taken, company invested 1000, okay, in a project whose value is only 800. Okay. Now listen carefully. Balance sheet. Fixed assets 9000. Okay, fixed assets 9000. Fixed assets added. That means new investment you kept na 1000 rupees. Now tell me, how much is the investment you made? 1000 is wrong. In this case, it is 1200. In this case, it is how much, sir? 1200. How much it is? 10,200. This 10,200 will be taken by equity. 1000 shares into 10.20 means what you have to understand here, the price of a share which is at 10 is now increased to 10.2. Why? 1200 divided by 1000 shares. Okay, 1200 divided by 1000. You take 1200 divided by 1000. How much? 1.20. So 1200 rupees. Okay, 1.20. Technically, the share price. Okay, the share price after declaring the dividend. The share price has come to 9. Now it was added by 1.2. 9 plus 1.2 is 10.2. That's how it became 10.2. Sir, I didn't understand what you said. So I can understand. Concept is not that easy. I will re-explain last part. Okay. So to summarize everything, financial management don't consider costs. Financial management will consider only values. So cost is relevant or irrelevant? Irrelevant. Cost is irrelevant. What is relevant? Value is relevant. Cost is irrelevant. Okay. Accountancy la cost they will take in the balance sheets. FM balance sheet don't consider cost. It considers the what? It considers the values. It don't consider costs. Okay, listen carefully. In this case, if you draw a balance sheet, fixed asset 9000, cash how much? 1000. This cash I am investing, equity 10,000. Number of shares 1000 shares into 10. This is a present situation. Now I am using this cash to make investment in a project. Okay, project I want to invest. So cash went out, project came in. Project is also called as what? Fixed asset. Additional fixed asset generated. How much? 1000. So here 1000 rupees, whatever is there already, we invested. But we have to take, what do you mean by this 9000? This 9000 is present value of future cash flows discounted at required rate. This is not cost, this is value. Like that here also I need cost of value of value. Cash 1000 rupees, I purchased an asset. But that asset is having the same value, a higher value of 1200 is the value. So 1200. How much is the balance sheet total? 9000 plus 1200, 10,200. Same 10,200 you need to take here. So this becomes 10,000. Sir, how can you adjust like that? That also I will explain. Now I am dealing with assets. Liabilities I will come after this. So tell me, what is the price? 1000 into how much? 10.20. 10.20 is the value. Up to here, hope you can understand what I said. Okay, now I will explain in an in-depth way. Try to understand this properly. Sir, why price of the share increased by 0.2 is a question. Okay, now listen carefully. How much is the value of this asset? 1200. Okay, how many shares are there? 1000. What is the value per share? 1.2. This value of 1.2 I got without investing, with by investing 1000. This is the value, positive number. But I invested 1000. So per share, how much cost I invested? 1. So this is a minus. I invested 1 crore, I invested 1 rupee, but I got an income of 1.2. That means what is the net impact? How much it gets generated? Plus 0.2 per each share. That itself is added to the price of the share. That's how the price market values will increase. That's why always remember, whenever company announces any kind of project in the newspaper, they will tell this is a positive 2 rupee project. They will tell immediately that day the market price of the share will increase by 2 rupee here and there. For example, the share price is trading today at 94. Company announced in the newspaper that we are starting a project which is expected to generate a positive 2 NPV project. Immediately share price will rise by 2 rupee. It will be traded suddenly at 96. Why? Because shareholders are in a intimation from the company that it invested 1000, which gives a value of 1200 to the company. So therefore, always remember capital budgeting chapter. That's why it's never a joke. Capital budgeting chapter, really I am telling you, my dear friends, you remember it's a heart of SFM. It's a heart of SFM. The financial management area heart is from the area from where the blood will pump is a capital budgeting. Capital budgeting concept you have to understand in depth, because that concept will give you the real meaning of what is a value. Okay, sir, hope everyone understood the meaning up to here. Okay, now good investment project. Now tell me, fixed asset 9000, cash 1000 is there. We invested in the fixed asset. Again, fixed asset will become 1000, equity 10,000. Normal balance sheet. That means Modigliani Miller original balance sheet is there. Na? It assumed that it is R equal to KE case. Okay. Next. Third case. Balance sheet. Fixed assets already are there. 9,000. Again, I am repeating. What is the meaning of this 9,000? Present value of future cash flow discounted required. This is a value, not the cost. And this is not one fixed asset. Project. New project, additional project we started na, we invested 1000 but it generated a cash flow of 800 only. That means the worth is only 800, not 1000. We invested 1000 but the value is only 800. Okay, 9800. It is 9800. So market price will fall to how much? 9.8. So this is a negative NPV project. I invested 1000, but the value is only how much? 800. So 200 divided by 1000, how much it is? 0.2. 0.2 is a reduction in market value. This is how you have to understand the concept clearly. Am I clear, everyone? Simply, this is 800 project na. 800 is the positive. You invested 1000 negative. So how much is the negative now? 200 negative. 200 divided by 1000 equal to how much? 0.2 negative. 10 minus 0.2, 9.8. Price of the share will fall. Negative NPV will affect the share price negatively, adversely, and positive NPV project will increase as the share prices. That's why NPV concept came in capital budgeting. Capital budgeting chapter, when it comes, we will discuss much in detail about what is the concept of net present value. Okay, now this is another thing that we have to explain. So now, if you see this balance sheet, and this balance sheet, all the three balance sheets are having same numbers, different numbers. Each balance sheet is changing because of R and KE details. In the first case, R is greater than KE, balance sheet is 10,200, wealth, 10,200 is a wealth balance sheet. Okay. Next, R equal to KE is at 10,000 wealth, R less than KE is 9,800 wealth. Means The wealth balance sheet will be same or different different. It differs from what R and KE calculations. It will change. But accounting balance sheet, it will be always the same because I don't consider R, KE values. I will consider the cost, which is always same because cost is what you put already. It's a historic cost. History can't be changed. So accountancy is a historic cost method. Financial management is a future value method. Okay, so Modigliani Miller concentrated on future value, the FM methodology, not the accounting methodology. Clear? So with this, we completed fixed assets analysis. Okay, so this is the balance sheet. I made analysis clearly. Meaning of fixed asset from FM point of view. Okay, whatever we have done, I have explained here very clearly. Okay, next, meaning of equity. So what is this equity meaning? See here. I am drawing a balance sheet. Fixed asset 9,000, cash 1,000, equity 10,000. Okay, equity 10,000. 1,000 shares of 10 each. Sir, this is equity share capital, reserves and surplus. What is this, sir? Directly you are written equity, and you are surprisingly, you are taking 10,000 here and you are taking this 10,000 here and telling the 10 rupee share price. Previous example, I have taken 1,200. Immediately I made it 10,200. I changed it here to 10,200. I writing here is 10.2. What you are doing, sir? I am not doing accounting. Again and again, hundreds of times I am telling. We are not doing accounting. We are doing financial management. We are doing financial management. Here you should not look into cost. Here you should not go into accounting standards. Here we have to go by principles of valuation. Okay? Look here. Look here now. My point is balance sheet analysis means what? Fixed assets are at 9,000. Cash 1,000, equity 10,000. So this is the 10,000 worth balance sheet. Okay, everyone understand this point clearly? Yeah. Now, listen carefully to the point. Now, this is the situation of this company. Now, let's go into the point. This particular balance sheet, how to analyze this equity? Till now, what we analyzed? Assets we analyzed. Now we are going with the analysis of equity. Listen, first point number 1. Share is a asset or liability. Yeah. First tell me. These are liabilities. These are assets. Now tell me. Share is a asset or liability. Yeah. Everyone listening to the class, tell to yourself. Share is an asset or share is a liability. Yeah. Share is a liability. Wrong. This accountancy is such a bloody concept. In order to balance the balance sheet, they go to any end. Listen. Law, what is an asset? Not FM. Normally, asset means what? Which generates a revenue is an asset. Preliminary expenses not written off is an asset in accountancy. Preliminary expenses not written off is generating revenue to you. It's generating revenue. Goodwill is an asset to you. Goodwill really generates revenue. Goodwill will create a brand to the company. That brand may generate sales. Sir, okay, goodwill generates. But you can't see with your eye. Okay, next. Valuation, if you want to do, tell me with common sense, accumulated losses is an asset. Accumulated losses is an asset. Accumulated losses generates revenue. Already people are crying, you are telling that enjoy the cry. Like that, assets will behave in accountancy. But FM never do that. Always a financial management focuses on the reality behind a concept, not assumptions behind a concept. So listen carefully to the point. People call share as a liability, but it is wrong. Why? I will explain. Okay? See here. Listen to this discussion properly. Whenever a project is announced, that project is giving a positive NPV, immediately the share prices are raising. A company is performing fantastic way. Sir, what do you mean by company performing well? Projects performing well. Project means what? Business. Business means what? Project. What do you mean by project? Project is a combination of various assets. Am I clear? What is the value of an asset? Present value of future cash flows. Discounted at required rate. Means, first point number one, value of a business depends on the project performance. Project performance will depend on individual asset performance. That means individual assets collectively will be called as a project. If that project is performing well, overall business of the company will perform well. Business performing well, share prices will increase. That means the share prices are directly connected to the business. That means if business is flourishing, prices of the share will increase. Business is depressed, prices of the shares will fall. That means what we have to understand, if the assets of the company are not performing well, means cost is 9,000 a, but the real value of an asset means what? Present value of future cash flows. Future what cash flows it is going to give? It doesn't give anything. Though you purchase at 9,000, financial management will consider the value of that asset as a zero, because it is not giving any future cash flow to me. Example I will tell. You purchased a plant and machinery. For 9,000 rupees. You purchased plant and take this balance sheet only. So you purchased a plant and machinery at 9,000 rupees. The moment you purchase the asset as 9,000, accountancy as per methods of accounting fixed asset to cash. 9,000 you recorded. The very next day, let's say it is R equal to KE. 9,000 you have recorded in FM balance sheet as well. Next day government said that there is a ban on using that machinery. Means, can I use that machinery and generate revenue in future? No. Therefore, what is the value of that asset? Present value of future cash. In future, what cash flows that asset is going to give? Ban is there. Zero value. So, financial management balance sheet of fixed asset is zero. Accounting will still it will show a WDV 9,000, which is nonsense to the code. That's why accountancy is a nonsense. So they don't project or they don't give a realistic information like what a financial management actually does. So therefore, fixed assets of 9,000, whatever we are seeing on the balance sheet is the real value of that particular fixed asset, not the actual cost. Cost can be anything, but financial management recognizes only the values, not the costs. So fixed asset value 9,000, cash 1,000. Now listen. Business flourish means projects are flourishing. Projects are flourishing means independently individual assets are performing well. Individual assets are performing well, projects are performing well. All the projects put together we call as a business. Assets put together project, projects put together business. Business flourishes, share price increase. Business don't flourish, share price decrease. That means share is dependent on what performance? Business performance. Share has no value on its own. For example, Kingfisher Airlines is there. Kingfisher Airlines. 2015, before the scam, Kingfisher scam, that particular company's share price is rising like anything every day. Suddenly they said that Vijay Mallya is a scamster, is a fraudster. The name came out. Immediately the very next day they thought that Kingfisher Airlines will not run in future. Immediately share price came to zero. From this what you have to understand? Yesterday it is having 600 share price. Today it is having zero share price. Why suddenly it fall? Because people came to know that in future business of Kingfisher will not be there. As per accountancy in the balance sheet still they will show a WDV. But financial management is actually what people will do, not accountancy. Accountancy is only for reporting purposes, not for decision making. You should not take any decisions on the basis of accountancy. You should take decisions as per the financial management. Therefore, always research and analytics will have more revenue than you project what already has happened. Therefore, accountancy will not have any kind of revenue. Okay. So, more than accountancy, what is important? Analytics. So, analysis on a concept is more important. That generates more revenue. So, therefore, the point is equity is something which does not have any value on its own. It derives its value from the business. From what's a business? So, no business, no equity. Kingfisher Airlines business has stopped. Yesterday it is having good share price. Today share price is zero because they found that business in future will not be there. No business, no share price. Business flourishing, share price will increase. What is business? Combination of projects. What is project? Combination of assets. That's all. So share is an asset which derives its value from another asset called as a business. But for accountancy purposes, to balance the balance sheet, they will show share as a liability. In the world, there is no concept called as liability. It is a connotation that will be used to settle the obligations. That's all. Really, there is no concept of liability. There is only one concept called as asset. So this is what I want to convey in this particular connection. So therefore, equity here does not mean equity, share capital, reserves and surplus. It is the value of the company. So that's why always I am writing, I am taking asset value. Okay. Previously what I have done, fixed asset 9,000. Additional project I started 1,200. So I am writing 10,200. Immediately I am taking this 10,200 here. Maybe most of the student might get surprised why he is doing that. This is the reason. Share value is a reflection of assets. It doesn't have any value on its own. Am I clear? So this is called as a market value. That's how the market value will change in the market every single trading day. Okay, this is the logic. So here in this model, the term equity is not equity, share capital, or reserves and surplus or both. It is a fair value of equity. Though people call share capital as an item of liability, in reality, share capital is also an asset. The reason is share value increases if business perform and share value fall if business does not perform. We have already learned that value of business is nothing but value of all the projects, and value of projects is nothing but the value of all the assets, and the value of asset is nothing but the present value of all future cash flows. So if company could not generate proper cash flows, means what? At the it is not giving a return at R, or it is giving a return not greater than R. That means it is giving less than R. Okay, then value of assets fall. Eventually the project fall, and thereby business value will fall, which will impact the share price. Therefore, it is clear that value of share is affected by value of business, and share does not have any separate value of its own. Hence, share is an asset of a kind which derives its value from the value of its underlying asset called as business. Another classic example in this connection, Satyam Company. Satyam Company scam happened 2009 year, 2008-9 year. At that time, do you know what happened? One day before the scam, share price is trading at 683. Suddenly it came to 14 rupees. So why is share price fall here? Suddenly what has happened? People found that businesses will not continue in future. Immediately share price fall. Those are all clear examples for this comment. So in finance world, unlike accountancy, there is no concept of liability. Liability is just a connotation used to settle the obligations. Hence, share price is just a balancing figure. This is the third part of our discussion. So please copy down the balance sheet interpretation. Hope you completed writing. So if you didn't complete, pause the video and write this concept as well. Completed writing. So now we completed entire writing part of meaning of equity. Now interpretations over. Now formula. So from the exams point of view, this is very important. Three formulae will be given in Modigliani Miller approach. Okay. I'm not just going to discuss about them. I will derive them. First formula I will put it on the sheet and later I will explain. Modigliani Miller has given three formulae. P naught equal to D1 plus P1 divided by 1 plus KE. Second model is MP1 equal to I minus E minus ND1. Next, NP naught equal to P1 into N plus M minus I plus E whole divided by 1 plus KE. Okay, now first let us derive and interpret all the three formulae. First, I will explain you the meaning of this first formula. Once after explaining the meaning, I will derive them. Okay, derivation is different, interpretation is different. Interpretation means explain the meaning of the formula. Derivation means telling how that formula came. Okay, some formulae will have both meaning and derivation. Some formulae will have only meaning and interpretation but not derivation. Okay, second one falls under that category. Second formula, whatever you are seeing, will not have a derivation, will have interpretation because it's not derivation. Sir, anyway, I will explain why it will be called so. So listen. First, what is P naught? Value of the share today. What is the value of a share today? Present value of future cash flows discounted at required rate. Present value of divided by 1 plus K means present value of. Future cash flows. D1 is future dividend. P1 is future sale price. Means if a person purchases a share today at P naught and receive dividend at the end of first year and sell the share at the end of first year, he will get a KE return. That's the meaning. Okay. Or value of asset is present value of future cash flows discounted at KE. Okay. So like that also you can understand the same definition. So this is the definition of this particular formula. But let us see the derivation. How this derivation has been done, let's try to understand. Tell me, what is the formal meaning of KE? Cost of capital chapter we have seen. KE equal to D1 by P naught plus G. In that chapter I already said G equal to P1 minus P naught whole divided by P naught. Okay, P1 minus P naught whole divided by P naught. This is called as a growth in value of the share. Today the share price is 100. After 1 year share price is 120. Means how much is the growth? 20%. Today the share price is at 100. After 1 year the share price rose to 105. What is the growth? 5%. Like that. That's the G. G is nothing but growth in the share prices. Okay. So but that means whenever I purchase a share, I will get two returns. Return number one. Return number one. Sir, what do you mean by return? Return means return on investment. What do you mean by return on investment? Return divided by investment. Return divided by investment. I will invest at P1 or P0 or P0. I should get some return or not? What return you will get? You will get D1 and you will get P1 minus P0 return. P1 minus P0 means I purchased at 100 and sold at 105. 105 is the selling price P1 and 100 is the purchase price P0. Okay, so this is the return. So simply if I break these two, common denominator is there now, I can break into two parts. D1 by P0, P1 minus P0 by P0. This P1 minus P0 by P0, people call it G in simple. Okay, growth in share value. So it is nothing but return on investment formula. Okay, okay, now instead of writing it G, I will rewrite it. KE equal to D1 by P0 plus P1 minus P0 whole divided by P0. P1 minus P0 whole divided by P0. Or you can, I will erase this, I will write in a different way such that you can understand. So see here, KE equal to D1 by P0 plus G. So I can write it KE minus G equal to D1 by P0. Okay. Sir, confusing na? I will erase and write. KE minus G equal to D1 by P0. Okay. Next. KE minus, now tell me what is G? P1 minus P0 whole divided by P0 equal to D1 by P0. So KE, okay, by 1 minus P1 minus P0 whole divided by P0 equal to D1 by P0. LCM take P0. Okay. So now tell me. P0 KE minus P1 minus of minus plus P0 whole divided by P0 equal to D1 by P0. P0 KE and P0. Let's bring together. P0 KE plus P0 minus P1 whole divided by P0 equal to D1 by P0. Denominators are same na? Cancel. P0 and that's not poke. That's P0 and KE. So take P0 common. KE plus 1 minus P1 equal to D1. Okay. So how can I write now? P0 into 1 plus KE, okay, minus P1 equal to D1. P0 into 1 plus KE equal to D1 plus P1. Okay, so P0 equal to D1 plus P1 divided by 1 plus KE. This is how the formula has been derived. That's why in denominator they got 1 plus KE instead of KE. Am I clear? Means this is called as single period holding formula. Means single period holding formula means you purchased a share today, after 1 year you received dividend and you sold the share. What is a return? 1 plus k is a return. That's 1 year formula. That's how many year formulas are? Only 1 year. 1 year holding period formula. Single period holding. Okay, this is how this formula has been derived. So this much derivation is there for the formula called as d1 plus p1 whole divided by 1 plus ke. Okay, next. One formula derivation also over. Next, mp1 equal to I minus E minus nd1. So what it is? mp1 represents amount to be raised by IPO. IPO or FPO, anything. How much amount you want? I have to issue M number of shares at P1 price. In the previous example, if you remember, we issued 111 shares at 9. 111 shares is after dividend or before dividend or after dividend. After dividend means it is P1. Okay, at the end of the year, I declared dividend and issued shares. Means I issued at P1. How many shares? 111 shares. So M is 111, P1 is 9. 111 into 9 is 1000. 999 also equal to 1000. Next, what is this I? What is this I? That means you are raising money. M into P1 means amount raised. Amount raised from public issue. Why you are raising money? What is the purpose of raising the money? I am raising the money for investment. For investment. Okay, now. So MP1 equal to I. Ante, how to understand this? Total investment. Okay, total investment. If there is 1000 investment, in our example, whatever we are taking now, okay, we declare 100 rupees cash as dividend and 1000 rupee cash is there. We declared everything as a dividend and the 1000 rupees we are raising money through public issue. Every time it may not happen like that in a company. In a company, what they can do? They can do like this. They have reserves and surplus, 1000 rupees. 500 they may declare dividend. Balance 500 only they use for investment. I repeat, in our first example, if dividend is declared, what will happen? Cash is there. Cash 100,000 rupees cash is there. Totally they declare dividend. Cash is zero. From where they have to raise? New issue is made. Again cash came. Cash again invested. So like that we have done. That means entire cash is declared as a dividend in the example. But every time companies may not do like that. 100 rupee cash is there. 500 I will declare dividend. 500 I will invest. Means project requires 1000. Okay. I have 1000 profit. In this 500 I paid dividend. 500 out of this 1000 I invested from my own money. Balance 500 I require from public issue. So amount to be raised by public issue is not total investment value. Total investment value minus earnings. 1000 earnings is there. Minus I will give dividend to, sir, I will first issue the public issue shares and then go for dividend. First I will go for dividend. I will first go for dividend. I will pay dividend. Once I pay dividend, price will become X dividend, P1 price. Then I will issue shares. Means first I need to declare dividend. That means the dividend is declared to shareholders who are coming in public issue. Existing shareholders are existing. Existing shareholders I call them N. New shares I call M. Existing N number of shares at D1 I will declare dividend. That's how this formula has derived. I minus E into I minus E minus ND1 means amount to be raised by public issue. I will issue at a X dividend P1 price some number of shares. How many number? We have to calculate that. Total investment is there. Total investment amount you need to raise. Maybe, may not be. But if company is using combination, hybrid combination of own money and public issue, in such case, total investment need not be raised by MP1. Investment minus earnings minus ND1. Earnings minus ND1. So investment is there minus E minus ND1. Okay. E minus ND1 they will calculate. E means total earning. Say 1000 minus I am issuing 500 as a dividend. Means 500 is already existing cash is there. Then why to raise entire 1000 rupees by way of public issue? 500 only. I require 1000 as investment minus I have 1000 rupee earning. In that 500 only I paid as dividend. Therefore 1000 minus 500. 500 only is required through public issue. That's the meaning. Okay. Next. This formula I will derive here. NP not equal to P1 into N plus M minus I plus E whole divided by 1 plus KE whole divided by 1 plus KE. What is P1? How this formula has come? Let's try to understand. So first tell me. Just now we seen the single period formula. Na? P not equal to D1 plus P1 divided by 1 plus K. This is LHS, this is RHS. Multiply both LHS and RHS numerators. Okay. This is P naught by 1. Okay. Numerators multiply by N. NP naught equal to ND1 plus NP1 whole divided by 1 plus KE. Okay. NP naught equal to ND1 plus NP1. If I deduct minus MP1 plus MP1, answer will change or will not change? Will not change. Minus 2 plus 2. Answer remains the same. Divided by 1 plus KE. NP naught equal to ND1 plus NP1 minus what is MP1? Already we have calculated. MP1 means I minus E minus ND1 plus MP1 whole divided by 1 plus KE. NP not equal to ND1 plus NP1 minus I minus of minus E means plus E minus of minus and minus of ND1 that equal to minus ND1 plus MP1 whole divided by 1 plus KE. Basic mathematics. Minus ND1 plus ND1 cancel. NP1 minus I plus E plus MP1 whole divided by 1 plus KE. NP not equal to NP1 plus MP1 minus I plus E whole divided by 1 plus KE. If I take P1 common, N plus M minus I plus E whole divided by 1 plus KE. This is how this formula has been derived. Okay. This is what Modigliani and Miller want to prove through their formula. So we just not only completed the formula, we also completed the formula with its analysis. Okay. Please copy down the balance notes. Please copy down the notes. Hope you have completed writing everything. It's enough time taken. So with this, we have completed Modigliani Miller approach model has been completed totally. Only one thing is left for us, doing the problems. Four types of problems are there. Just like that, we will complete now. After this much discussion on the model, it doesn't take a lot of time to understand. It will be very easy problems, just like a cakewalk you will do. When remaining all the others are struggling to understand the formula, we also done the derivation. Everything has been completed. Nothing left out, nothing pending. Everything is very clear. Damn clear concepts are there. Once after completing all these, we are just having a pending to complete out the problems in this regard. That also we will do once after this lecture. With this lecture will be cut exactly. Next lecture we will start with problems doing. After that we'll start with very important. If I taken Modigliani Miller approach so seriously, you should understand how seriously we will take the chapter capital budgeting. So capital budgeting chapter will be the brainstorming to you, definitely completely different understanding you will get. What you learned in capital budgeting before and what you learned in our classes will be completely different. Each and every point inside the capital budgeting, starting from average rate of return to the last critical analysis and conflict analysis in capital budgeting, every concept we will understand in a clear sense. Okay, so thank you very much. Next lecture we will be doing the problems, completing this chapter called as dividends. We'll go to the next one, capital budgeting. Thank you.